All right, let's kick things off with a question you've probably seen a million times in your prep. Picture this. You've got a 3-year contract, and the total profit is a cool 50 lakhs. Now, the big question is, how much of that profit do you actually book in year 1? Go on, take a guess. What does your gut tell you? So, if you thought, hey, I'll just wait till the end and book the whole 50 lakhs in year 3, well, you've just walked right into a classic ICAI trap. Seriously, booking 0 until the very end? That's flat out wrong, and it's an easy way to kiss those precious marks goodbye. See, the real puzzle here is figuring out how to spread that revenue and cost over several years. And that's exactly what we're diving into today. We're going to crack open AS7, all about construction contracts. This is the standard that gives us the playbook for handling these massive long-term projects, so we can book our profits and losses the right way year after year. Okay, so let's start with the big problem that AS7 is designed to solve. I like to call it the yearly profit puzzle. Think about it, right? These contracts for building huge things like bridges, dams, or skyscrapers, they take years. So the number one challenge is, how do you split up the total revenue and costs and assign them to the right accounting period? That's the whole game. So first things first, what even is a construction contract? The magic words here, the ones you need to burn into your memory, are specifically negotiated. This means it's a deal between a contractor and a customer. And this is super important, guys. AS7 does not apply if you're building something for yourself. Nope, that's a self-constructed asset, and that's covered by AS10. AS7 is purely for when you're building for someone else. And you know the scope of AS7 is way bigger than most people think. Yeah, obviously it covers building new stuff, your bridges, your dams, the usual suspects. But it also covers services that are directly linked to the construction, like hiring architects or project managers. And get this is a good one. It even covers destroying and restoring assets. So if the contract is to tear down an old factory and clean up the land, boom, that's AS7 territory. All right, let's move on to the next piece of the puzzle. What do you do when you have one giant contract for a bunch of different assets? Or the other way around. What if you have a bunch of separate contracts that all feel like one big project? This is where we have to talk about combining and segmenting contracts. Okay, listen up, because this is a hot spot for exams. ICAI loves to ask questions on this. So segmenting is when you take one big contract and break it down into smaller ones. You do this if you have separate proposals for each part, you negotiated each part separately, and, this is key, you can track the costs and revenues for each one. The flip side is combining. That's when you take a bunch of contracts and treat them as one single package. You do this if they were all negotiated together as a single deal, they're all super closely related, and you're basically doing the work all at once. It's all about looking at the real substance of the agreement. And here's a pro tip for your exam. Let's say you're halfway through a project, and the customer says, hey, can you build this other thing for me too? Well, you treat that additional asset as a totally separate contract if one of two things is true. 1, it's really different in its design or function. Or 2, you negotiated the price for it completely separately from the original deal. Got it? Okay, let's put this into practice. Check out this scenario. A company is building a big industrial complex. They've got separate proposals for each unit, they negotiated for each unit separately, and they can track the money, the costs, and revenues for each one. So what do you think? Is this one contract, or should it be treated as many? Well, if you remember the rules we just talked about, all 3 conditions for segmenting are met. So you guessed it, they absolutely have to treat each unit as a separate construction contract. All right, now it's time to get into the nitty-gritty, the numbers. We're going to break down exactly how you calculate the 2 most important figures for any contract, your revenue and your costs. You have to get this part right, because everything else, especially your yearly profit, depends on it. So, contract revenue. It's not just the price you agreed on at the start. You've also got to include things like variations. You know, like if the customer suddenly wants an extra floor. You can also add in claims and incentive payments. But, and here's a classic IKI twist, so listen closely, you can only include claims and incentives if it's probable that you'll actually get the cash and if you can reliably measure how much it'll be. If you fail either of those tests, you cannot include it. Simple as that. Let's walk through this example to make it crystal clear. We start with the fixed price, which is 5 crores. Then there's an incentive of half a crore. We can include that because it's probable we'll finish early. Next, we add in the cost recoveries for materials and labor, which are part of the deal. Then we add that 1 crore for the variation. Remember that extra floor? And finally, the 0.02 crore claim for approvals. Add it all up, and our total contract revenue comes out to 7.40 crores. See how it builds? Now let's flip to the other side of the coin, contract costs. What gets included? Well, first you have your direct costs, the obvious stuff, like labor on site and materials. Then you have costs that can be allocated, like insurance or general construction overheads. And finally, you can include any other costs that the contract specifically allows you to charge back to the customer.
Okay, pencils down for a second because this is where students lose a ton of marks. You need to know what to exclude. General admin costs, out. Selling costs, out. R&D costs, also out. The only exception is if the contract explicitly says the customer will pay you back for them. And another big one, depreciation on a machine that's just sitting there, idle, not being used for the specific contract, you cannot include that. Remember that.
Okay, so we've got our revenue figured out, and we know what costs to include. So how do we actually book them each year? This leads us to the heart and soul of AS7, the main event. It's called the percentage of completion method, or POCM for short. So what is POCM? It's actually a pretty simple idea. It just means you recognize your revenue and costs bit by bit as you do the work. Think of it like this. If you're 40% done with the project at the end of year one, you get to book 40% of the total revenue and 40% of the total costs in that year. It's just the matching concept in action. You're matching the income you've earned with the expenses you had to pay to earn it. Makes sense, right? But hold on, you can't just use this method whenever you feel like it. There are rules. For a fixed price contract, you have to meet all 4 of these conditions. You've got to be able to measure your total revenue reliably. You've got to be pretty sure you're actually going to get paid. You have to be able to measure your stage of completion and how much is left to finish. And finally, you have to be able to track your costs clearly. If even one of these is a no, you cannot use the percentage of completion method. It's all or nothing. Now for cost-plus contracts. You know, the ones where you get your costs covered plus a fee. The rules are a bit easier. Here, you only need to meet 2 conditions. 1, it's probable you'll get the economic benefits. And 2, you can clearly identify and measure your costs. The bar is lower here simply because there's a lot less guesswork about your final revenue. Okay, we've got the method, we know the rules. Now for the final step. Let's put it all together and see how we recognize the actual profit or loss in our P&L statement each year. And this right here is one of the most important rules in accounting, period. This is a non-negotiable, must-know point for your exam. The second you figure out that a contract is going to lose money overall, you have to recognize the entire expected loss immediately, right then and there. You don't wait, you don't spread it out, you book the whole loss up front. This is the principle of prudence, and ICAI will test you on it. So let's see how this works with some numbers. Our total contract price is 2 lakhs. In year 1, we're 45% complete. So we recognize 45% of that revenue, which works out to 90,000. The costs for year 1 are given as 81,000. So what's our profit for the year? Simple. Revenue of 90,000 minus costs of 81,000. That gives us a profit of 9,000 to book in the P&L for year 1. Okay, moving on to year 2. The contract is now finished. The total revenue for the whole project is 2 lakhs. Now, we already booked 90,000 of that in year 1, right? So the revenue left to recognize in year 2 is 1,10,000. The costs we incurred in year 2 are 89,000. So the profit for this year is 1,10,000 minus 89,000, which is 21,000. And if you check the math, the profit from year 1, which was 9,000, plus the profit from year 2, 21,000, gives you a total profit of 30,000 for the entire contract.